Aehr Test Systems dropped 4.7%. Lab scores at 48. Hold. Single customer concentration near 80% exposes them to massive capital expenditure delays in the electric vehicle sector. Yet, their proprietary wafer-level testing platform remains absolutely critical for scaling next-generation silicon photonics. Our full teardown reveals whether this dip is a structural trap or a generational buying opportunity. Aehr Test Systems is flashing on every screen after plunging 4.74% to $72.60 last Friday, while its storage peer Seagate climbed 2.3%. This divergence exposes a sharp capital rotation within the artificial intelligence infrastructure as we head into Aehr's critical earnings report. Despite a recent silicon photonics production order, Wall Street is aggressively pricing in execution risks, punishing the stock ahead of the print. Investors are rotating capital away from speculative testing plays and into established hardware layers. The market is demanding flawless guidance, leaving zero margin for error as macro headwinds mount. The physical bottleneck here is wafer-level burn-in, specifically for silicon photonics. Aehr's FoxXP system must dissipate up to 150 watts of heat per optical die across 2,048 channels. While Teradyne's package-level testers test chips individually after dicing, Aehr's system tests 18 wafers simultaneously. However, if optical transceiver yield drops below 85%, this capacity remains underutilized. The engineering reality confirms the market's caution. Quarterly financials showing modest revenue momentum for Aehr. By Q4 2026, monetary policy and tariff uncertainty will compress Aehr Test Systems' valuation multiple by at least 15% as high interest rates freeze customer capital expenditure. With the Federal Reserve holding interest rates at 3.63% and CPI at 0.6% YOY, the cost of capital remains highly restrictive. This monetary friction has already hammered Aehr's revenue growth down by 43.7%. as customers delay purchasing expensive test systems. Prediction markets place recession risk at 7.1%, adding to corporate hesitation. While TSMC's monthly revenue surged 30.1% YOY to approximately $13.0 billion, that capital is not trickling down to niche testing equipment. Instead, capital is rotating out of speculative testing suppliers and into cash-flowing infrastructure giants like Seagate. On the policy and geopolitical front, looming trade wars and tariff risks threaten to disrupt the global semiconductor supply chain. Specifically, any new tariffs on optical transceivers would directly hit Aehr's customers in key manufacturing hubs. Because Aehr relies on global assembly lines, trade conflicts could severely impact its gross margins. Furthermore, the high short float of 14% shows that short sellers are heavily betting on these supply disruptions. While Wall Street analysts remain bullish with 8-buy ratings, political backlash against rapid AI capital expenditure is forcing hyperscalers to scrutinize hardware costs. Aehr reported earnings per share of negative $0.05, beating the Wall Street estimate of minus 0.07 by 30%. A solid beat that signals strong execution. Aehr is trading below its 20-day average, currently at 72.6. Here's what management wants you to hear. Silicon photonics production order. That's the phrase Aehr Test Systems plastered across every headline. 3 words designed to conjure images of AI-driven hyperscale data centers, optical interconnects, and a small-cap hardware player finally breaking into the big leagues. But here's what they're not saying. Insiders have net sold 247,104 shares in the last 90 days. That's not a trickle. It's a steady exit from the people who know the order book best. When executives sell during a 410% rally, it's not confidence, it's risk management. The PR narrative screams growth, but the Form 4s whisper caution. Management called demand record. They're celebrating a follow-on order, linguistic downgrade alert. A follow-on isn't new business. It's a customer doubling down on a known quantity. That's not expansion, it's validation of a niche. Meanwhile, R&D as a percentage of revenue ticked up to 17.7%, a 20% YOY jump. That's not efficiency, It's a bet that photonics testing is a long-term play, not a near-term margin driver. Wall Street's positioning tells the real story. Analysts keep raising targets, but ARK trimmed its stake last month, and Fidelity slashed its position by 53%. The sell side is cheering, the smart money is booking gains. What management is saying is silicon photonics. What the lab hears is, we're a one-trick pony with a short runway. Watch for R&D as a percentage of revenue to drop below 15% in the next 10Q. If it does, the growth story is over. The momentum breakdown for Aehr. RSI sits at 23, pointing to oversold territory, potentially setting up a bounce. MACD is currently bearish, with downward histogram pressure. Aehr's bull case rests on its proprietary wafer-level testing platform, which is critical for scaling silicon photonics. As optical interconnects replace copper in next-generation AI clusters, Aehr's systems offer unparalleled throughput. This unique positioning makes it an indispensable gatekeeper for high-performance computing hardware. But here's what breaks the bull thesis: extreme customer concentration and slow adoption of optical computing. If major customers delay their silicon photonics ramp, Aehr's revenue collapses. Supporting this bear case, smart money is already exiting. Fidelity Small Cap Growth Fund aggressively trimmed its position by 53%, signaling low conviction in Aehr's near-term recovery. The core question is, can Aehr diversify its customer base before its current testing contracts expire? The lab's answer is a definitive no. While the recent silicon photonics production order is a positive step, Aehr remains dangerously reliant on a single-digit number of customers. If their internal wafer yields improve, they will reduce their utilization of Aehr's systems, leaving Aehr with massive unutilized capacity and collapsing margins. If Aehr secures 2 new high-volume customers by Q3 2026, the stock could rally to resistance at $115.88. But if customer concentration persists, expect a breakdown past support at $66.94. The lab's call, with an AI score of 48 out of 100, the downside scenario is highly likely. The key confirmation signal is the upcoming earnings report. Here's the macro picture shaping Aehr. The Fed's high rates make chip Seagate rose 2.3%. Lab scores at 61 out of 100. This rally is anchored by their proprietary HAMR technology, deploying microscopic lasers to achieve over 30 terabytes of storage per drive. This hardware shift radically lowers hyperscale data center operating costs. Our full teardown reveals if this laser-driven margin expansion can actually outrun solid-state competitors. Seagate technology captured the spotlight last Friday, climbing 2.3% to $910.34 as capital rotates into physical hardware ahead of its July 16th earnings report. While sector peer Aehr Test Systems plunged 4.7%, the market is aggressively pricing in Seagate's expanding role in AI cold storage, archival data centers that house massive training datasets. Wall Street is betting that the explosive growth of raw AI training data will revive this legacy hard drive giant. Capital is fleeing speculative software and flowing directly into physical storage infrastructure. But the physical reality of hard disk drives, magnetic storage devices used for high-capacity archival data, hinges entirely on Seagate's proprietary HAMR, a technology using microscopic lasers to write data at extreme densities. To justify its valuation, Seagate must scale HAMR to 30 terabytes per drive. This laser-based architecture must defend Seagate's scale moat against WDC, Western Digital Corporation, Seagate's primary rival in the hard drive duopoly, as solid-state drives threaten to steal market share. If Seagate's laser-based yield rates falter, WDC will capture the duopoly pricing floor. Engineering, not market hype, will dictate if Seagate survives this transition. Quarterly financials showing modest revenue momentum for Seagate. By the fourth quarter of 2026, escalating tariff friction will compress Seagate's gross margins by at least 150 basis points as supply chains are forced to relocate. While capital fled silicon testing peer Aehr Test Systems, dragging it down 4.7%. It rotated into Seagate's physical storage. But Seagate must navigate a complex macroeconomic wave. With the Federal Reserve holding its benchmark interest rate at 3.63%, borrowing costs remain a headwind for capital-intensive R&D. While a normalizing yield spread, the difference between long-term and short-term Treasury yields indicates stabilizing growth. Predictive markets still price a 7.1% recession risk. This economic friction directly threatens enterprise IT budgets, even as Seagate's revenue growth surged 44.1%. Geopolitical forces are now actively reshaping Seagate's operational map. Strict U.S. export controls, government restrictions on shipping sensitive technology abroad, block Seagate from selling high-capacity hard drives to major Chinese cloud data centers, cutting off a vital high-margin revenue stream. Simultaneously, the threat of new import tariffs on electronics forces a costly reconfiguration of manufacturing hubs away from Asia. On the social front, a sudden drop in consumer PC demand could collide with production delays of Seagate's new laser-based drives, leaving the company highly vulnerable. While Wall Street focuses on the AI storage narrative, the physical reality of a trade war and shifting global supply chains will test Seagate's scale mode. The macroeconomic tide is no longer a gentle current. It is a direct threat to Seagate's margins. Seagate reported earnings per share of $4.10, beating the Wall Street estimate of $3.54 by 15.7%. A solid beat that signals strong execution. Seagate HDD storage is trading below its 20-day average. Here's what Seagate's management wants you to believe. AI storage growth outlook. That's the phrase they've plastered across every press release, earnings call, and investor deck. 3 words designed to make you picture data centers stacked with Seagate drives, feeding the insatiable appetite of AI models. It's a narrative built for momentum, cloud, AI, growth, all the buzzwords Wall Street rewards. But here's the first crack in the facade. Insiders have net sold 151,070 shares in the last 90 days. That's not a trickle, that's a deliberate exit. When executives who know the product roadmap best are selling into a rally, it's not confidence. It's a signal that the upside is priced in and the downside is underappreciated. Now let's talk about the numbers management isn't emphasizing. EPS beat by 15.7%, sure, but R&D as a percentage of revenue is up only 10.7% year-over-year. Peanuts for a company trying to pivot to AI storage. That's not the spending pattern of a firm betting the farm on next-gen tech. It's the budget of a company milking legacy HDD margins while the market prices in a transformation it isn't actually funding. Wall Street's cheering. Wells Fargo just upgraded to overweight. Price target up to $1,100. But ARK trimmed its position, and short volume spiked 28.9% of daily volume, well above baseline. That's not a vote of confidence, it's a hedge. The engineering reality? Seagate's HDD business is still 80% of revenue, and AI storage isn't scaling fast enough to offset the cyclical downturn in traditional data center demand. The momentum breakdown for Seagate. RSI sits at 38, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Seagate's bull case rests on its proprietary HAMR, heat-assisted magnetic recording, a technology using microscopic lasers to pack data at extreme densities. This engineering advantage positions Seagate to capture massive archival drive orders as tech giants upgrade data centers for AI workloads, driving its 108% EPS growth. But here's what breaks the bull thesis. Solid-state drive manufacturers are aggressively lowering prices to steal enterprise storage market share. Furthermore, strict export controls block sales to Chinese cloud data centers. While BofA Securities raised its price target to $1,150, Susquehanna maintains a neutral stance at $775, reflecting deep skepticism. Can Seagate scale its laser-based HAMR drives fast enough to offset the structural decline of legacy consumer PC storage? The lab's answer is a definitive no if manufacturing yields remain unstable. If Seagate cannot achieve high-volume production of 30 terabyte HAMR drives, enterprise customers will opt for cheaper solid-state alternatives. This would trigger immediate margin degradation, making Seagate's trailing P/E, price-to-earnings ratio, a valuation metric comparing stock price to per-share earnings, of 86.2 times completely unsustainable. If Seagate beats earnings on July 16th and guides for accelerated HMR shipments, the stock will challenge resistance at $1,093. If production delays persist, expect a post-earnings sell-the-news drop to support at $820. With an AI score of 61 out of 100, the lab expects a neutral consolidation phase as bearish MACD. Moving average convergence divergence, a trend following momentum indicator. Momentum confirms the near-term downside risk. Here's the macro picture shaping Seagate. Strict U.S. export controls on advanced semiconductors to China directly restrict Seagate from selling high-capacity hard drives to major Chinese cloud data centers. Additionally, the threat of new import tariffs on electronics forces the company to costly reconfigure its supply chains away from Asian manufacturing hubs to protect its profit margins. As artificial intelligence expands, Seagate relies on its proprietary heat-assisted magnetic recording technology, which acts like a microscopic laser to pack vastly more data onto storage disks than competitors can manage. However, the company faces a constant threat from solid-state drive manufacturers who are rapidly lowering their prices to steal market share in the enterprise storage space. Over the next 6 months, the biggest growth trigger for Seagate will be a surge in hard drive orders from giant tech companies upgrading their massive data centers for artificial intelligence workloads. Conversely, the biggest danger is a sudden drop in consumer PC demand combined with production delays of their new laser-based drives, which would quickly hurt their short-term revenue. Aehr's wafer-level burn-in die count just hit a 3-year low. That's the only number that matters. Are you holding Aehr? Drop your entry price in the comments. Let's compare levels. This isn't financial advice. We're engineers, not brokers. Markets move fast, data gets stale, and your risk is yours alone. Past performance never guarantees future returns. Do your own research before you trade. Hit subscribe so you don't miss our next deep dive on CAPEX cycles. If you want our full breakdown on Rocket Lab, the link is in the description. Stay sharp, Lab.